Doing well. I hope you're better than the markets are today because we're seeing a lot of red across the board today. I want to look quickly at the markets here and then we'll get into the subject of today's video because we've got a lot to talk about. We're going to talk about why the looming financial crisis that we're on the verge of is going to be worse than 2008. And we got a warning from JP Morgan recently to that extent. And I want to go over that, but I'm also going to show you some data that they didn't really mention that illustrates why this looming crisis is going to be so much worse this time around. Now, today we have got the major stock indexes in the red. You can see there we got the S&P 500, the Dow in the red, the Nasdaq just barely eking out a gain, the Russell 2000 in the red. But the most important thing today is look at this. You've got the 10-year yield up another 2.2%. That is a huge move up in the 10-year yield, and this is something that we've been witnessing over the past several trading sessions ever since the FOMC meeting. We've been seeing the U.S. bonds selling off in a very big way, and that is reflected in this spiking interest rate. And that is very likely going to be one of the things that contributes to this crisis. Now, this is the headline that we got from JP Morgan. So this is published in Forbes. This one's from Forbes. Market looks an awful lot like disastrous 2008, top JP Morgan strategist says. And we're going to go through all of the points that they brought up, but really there are some important charts that I want to show you. This is something that we really want to be paying attention to, folks, because, if you're not getting prepared for this, you may be caught without the proper preparations in place when it's too late to get prepared. And, we hear a lot of talk about soft landings and the mainstream media telling us everything's fine. The Fed's going to be able to get inflation under control. They're going to be able to usher in a soft landing. But there's a lot of data that indicates that that's not the case. So again, we will check that out. Now, I'm going to read you just the introduction to this article, and then we'll start getting into the charts. So the ongoing discussions about the health of equities and the U.S. economy are eerily similar to the discourse leading up to the Great Recession, JP Morgan's chief quantitative market strategist wrote in a Wednesday note to clients, an ominous warning as the Federal Reserve, Wall Street, and Main Street alike cross their fingers the economy will have a soft landing. And how many times have we heard that term soft landing bandied about? And, according to the JP Morgan analysts here, one of the reasons that they're concerned is because prior to the 2007-2008 financial crisis, there was a lot of talk about soft landings. Now, one important difference between this crisis, which we are on the verge of, and the 2008 crisis is something I want to cover real quick, and that is in 2008, it was a crisis originating in the real estate sector. There was, the subprime sector of the market. The loans were being defaulted on. They were getting rolled up into these derivative products that credit rating agencies were rating as A+, and really they should have had a much lower credit rating. It gave the system all of this exposure to these defaults, and the system required a bailout as a result. But this time around, it's not a crisis originating in the real estate sector, although the real estate sector will likely be affected. This time around is a sovereign debt crisis. This is going to mean everybody is going to need bailouts, not just the banks. It's going to be the U.S. government that needs a bailout. It's going to be the dollar that needs a bailout. And that means that the dollar is going to lose a lot of its purchasing power this time around. That's my forecast anyway. And that means that despite the fact that we are seeing a pullback in the price of the precious metals, I am continuing to add them on the way down to my stack. I view this pullback as a buying opportunity. Today we have the silver spot price down to $21.44, gold down to $18.41. Now, if you want to buy gold and silver, make sure you check out today's video sponsor, sdbullion.com. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. And certainly those spot offers just got a lot more appealing considering that we've seen this significant pullback in the price of gold and silver. But I do think that ultimately this crisis, when the Fed busts out their response to it, tangible goods are going to be what you want to have your hands on. So I'll just give you that spoiler right now. Now, moving on here, let's read some of the key facts from this article. Today's market conditions rhyme with 2008, according to a JP Morgan group led by Marko Kalanovic, specifically citing the rapid increase in interest rates and the relatively bullish prevailing sentiments among investors despite a laundry list of worrisome signs. And that's true. Right now, you still see folks in the mainstream media touting the stock market, touting the soft landing idea, and that is what you would expect near a top, is you would expect investors to be bullish because once you get everybody bullish, there's no one left to buy, and then it is on the way down. And similarly, I mean, I think we're going to see something very similar with the precious metals, with gold and silver. It's very possible that we could see a bit of a sell-off, especially in the paper spot price of these metals as this crisis plays out. I've been warning of this for several months now in a number of videos. Of course, when I was putting those out, warning of a potential collapse in the spot price of gold and silver, I was widely lampooned, but now it's playing out that way. And, again, it doesn't mean that you want to be going out and selling your gold and silver. Most of the gold and silver that's getting sold off right now is paper contracts. It's not physical metal. But when the crisis really kicks off, I do expect that the physical stuff, likely the premiums, are going to soar on this. And that is why the fact that premiums are still low and the spot price is low, I think it's a great time to be stacking. Not financial advice, but just, my way of thinking about this. And kind of, I'm a contrarian at heart. So I think when gold and silver bottom out, you're going to see a huge amount of pessimism about the metals, that they're going to be going much lower. But the thing is, everybody who's going to sell will have already sold. And so, again, I'm kind of a contrarian at heart. That's how I view these things. Now, another key fact here from this warning from JP Morgan. Going into the crisis in 2007, investors were discussing the exact same topics as today: Fed pause, consumer resiliency, soft landing, and strong jobs, noted Kalanovic, reprinting a January 2007 note from his bank warning about the lingering impact of higher rates to prove his point. Now, I want to look at the first chart here that I want to present to you today, and then we'll be coming back to this article from Forbes about the JP Morgan warning, going over some more points. But, if you want to see the most important difference between now and 2008, it really can be summed up in one chart, and that is this one. This is the U.S. national debt. This is courtesy of the Federal Reserve, and you can see that back in 2008, the U.S. national debt was under $10 trillion. Well, today, it's north of 33. And so that's a big deal when you're going into a crisis that is being triggered by soaring interest rates. The more debt that you have to service, the bigger a problem it is when you have soaring interest rates. And so if a increase in the federal funds rate triggered the 2008 or 2007 financial crisis, if that was a predecessor to that, well, the soaring interest rates right now will put that much more pressure on this economy, especially on the federal budget, because, now with interest rates as they continue to move up and the treasuries that are outstanding continue to roll over to this higher yield, the cost of servicing the national debt is exploding. It's almost to $1 trillion annually, and there's no sign of it stopping, especially if the Fed persists with their longer for higher mentality, which they told us about at the last FOMC. It means that the interest cost on the US debt is going to continue to skyrocket to much higher levels than in 2008. And, again, this time around, it's going to be a debt and credit crisis. It's not going to be limited to the real estate sector. Everyone is going to need a bailout this time around. And then this is another chart that I want to draw your attention to compare 2008 to now. So this is the federal funds effective rate chart, and you can see that prior to the 2008 crisis, the Fed was hiking from a very low level. After 9/11, Alan Greenspan slashed rates down to 1%. They started to hike in 2004. We saw the rate still down at 1%. Now, by 2006, it had gotten up to about 5.25%. And you can see the time frame over which that occurred here on the chart. Now, today, not only are debt levels across the board much higher than in 2008, but the increase in the federal funds rate that we've witnessed is both steeper and more rapid than in 2008. And you might wonder, well, why hasn't that triggered a collapse yet? Well, we're going to get into that in just a minute. But first, just examine this. So we've got the rate going from, in September 2021, basically zero, up to today, where you've got it essentially at 5.25. This chart shows it at 5.33, so slightly higher than it was in 2006. But you can see that that is a bigger increase because it's starting at a lower point and getting to a higher rate. So this is a huge increase in the federal funds rate in a very short period of time. And when you have a system that is as laden with debt as we do, this is a huge problem. Now, let's get back to the article here because there's a couple other points I want to touch on that they mention. So, the stock market and US economy ultimately collapsed 15 years ago, a dire scenario most experts don't foresee. All right, so first of all, if you recall the lead up to the 2008 financial crisis, I mean, I was a very young man at the time, but I do recall, I was kind of following things at that point, not to the extent that I do today, but I mean, there wasn't a lot of pessimism in the markets. And you can go back and find those clips of, I think it's called Peter Schiff Was Right. And he was one of the few people who actually foresaw the collapse that occurred. But, he's arguing against all these very popular talking heads and pundits who were all saying, oh, it's all going to be good times. Everything's going to be fine. So, the fact that everybody is talking about a soft landing today, it's not indicative that we're going to have a soft landing. I mean, this is exactly what people were saying before the 2008 crisis. But of course, the scenario now is much, much worse than it was then. Moving on here, Kalanovic says several signs are more urgent today than they were then. Yeah, exactly. Such as a five-fold greater increase in the federal funds rate over the last 18 months compared to the rate hike between 2002 and 2008, so that's what the chart we were just looking at, a more global tightening of monetary policy, and a disproportionate impact of higher rates on smaller businesses. Yeah, and I would also add on smaller banks. We're going to show you a chart here in just a moment, which will illustrate that very nicely. Now, something that this article doesn't touch on that is different between now and 2008, they mention here the global tightening of monetary policy. You also have to take into account global de-dollarization and the potential end of the petrodollar. Back in 2008, Saudi Arabia wasn't talking about selling their oil for yuan. They weren't talking about joining the global south and BRICS. You had China and Japan were both buying U.S. treasuries. They weren't dumping them onto the market like they are today. So that's a huge difference between now and 2008 is the overall geopolitical climate against which this is all occurring. Now it is much less favorable for the U.S. economy, with China and Japan, the biggest holders of U.S. treasuries internationally, dumping U.S. debt. It's going to be a lot more difficult for us to export that inflation and that debt around the world. In fact, all that debt that they were buying back in 2008 right now is coming back because they are selling those treasuries onto the market. So that is very ominous, and it's at the same time that the Fed is trying to sell more debt onto the market, and the Treasury is selling more debt onto the market at a rapid pace. I mean, why do you think we see the 10-year yield spiking up today? It's up over 2% in one session. That's a huge move in the U.S. debt market, supposedly the most liquid and largest debt market in the world. To see a move like that, that is a big deal, especially when you see it day after day after day. It's not a good sign for these banks. Now, I'm going to pause real quick here and just say a huge thank you to everybody tuning in. We're over 300 people. That is amazing. It's kind of heartening to me because it makes me realize that some people are paying attention to what is going on. And that's very important because I think the more people who get prepared for this crisis ahead of time, the better off we're all going to be. It's going to be one more person that doesn't need a handout, that doesn't need a bailout, because there's going to be a lot of bailouts, folks. Now, if you would do me a favor, please smash that like button. We're at about 57 likes right now. I would love it if we get to 100. I would be just blown away if we could do that. And I know you all are awesome and will make it happen. So if you haven't smashed that like button yet, please do so. Now, let's see what else we got here. So the disproportionate impact of higher rates on smaller businesses. Certainly, there's more business debt, but we're going to show a chart here in just a moment, which is really going to illustrate that point nicely. First, I want to just touch on a few more points that JP Morgan gets to, and then we'll get into some very interesting data. So Kalanovic suggests several factors, such as consumers having more savings and home buyers and corporate borrowers locked into loans at far lower rates available today, are causing lags to see the full impact of rate hikes. And that is a huge one. That's a big reason why we haven't seen a collapse yet, despite the fact that the Fed has hiked rates so quickly. But there's a lot of signs that those factors are about to come to an end. We are at 90 likes right now. Thank you all so much. I appreciate that. Can 10 more people smash that like button? That would be awesome. All right, and then finally, the bearish Kalanovic suggested clients should shun equity and credit investments for fixed income as long as interest rates remain in deeply restrictive territory and the overhang of geopolitical risks persists, nodding to Russia's ongoing war in Ukraine and other global unrest that have sent oil and other commodity prices surging. Yeah, we've seen the decline actually in the price of crude oil today, but we got a warning from OPEC about how the lack of investment will be driving oil much higher. So, my view is that we may see the price of oil pull back a little bit more here if we do get some kind of a pan sell off. But ultimately, I think oil, along with gold and silver and tangible commodities, are going to be much, much higher once they start printing the currency again. And that is coming in very short order. Now, one of the things that they mentioned there in that article was that savings have created a lag before we see this crisis. So let's take a look, at this chart of the US savings rate. And I think there's a lot to that. I mean, if you look leading up to the 2008 financial crisis, savings rates were actually lower than they are today, 2.4%. A lot of people were doing things like um, excuse me, refinancing their homes. People were spending, they weren't saving. They thought the good times were going to continue forever. Of course, they learned that that wasn't the case in 2008, but it's a much different scenario right now. I mean, look at the spike up in the savings rate when we had the stimmy checks going out. I mean, this is like a 33% savings rate. It's far higher than any other time on the chart. And of course, when you start sending people thousands of dollars of printed fiat currency, yeah, they can save some of it. And so there were a large stockpile of consumer savings heading into this crisis when the Fed started their rate hikes. But those are being depleted now. I mean, for one thing, we're down to about 3.9% on the US savings rate right now. But if you want to talk about signs that the consumer is at the end of the rope, for one thing, we just got that huge GDP revision where consumer spending was reduced from 1.7%, I think was the original number. I'm not 100% sure about that. I don't have that in front of me, but something like that, down to 0.8%. It was a huge revision downward. It's like they keep giving us these fake economic numbers and then they just think they can like slide in a revision later on. I've got some folks in the chat, they're saying the channel is getting throttled. Well, listen, if the channel is getting throttled, that wouldn't surprise me. Certainly, the job of the mainstream media and the powers that be is to maintain the calm. It's not to get the warning out. They want everybody to be super calm. If you want to know, an illustration of that, what was it in Ukraine? They knew they were going to get invaded by Russia, but they were still telling people everything was fine right up into the last minute because they didn't want the highways to get jammed up with traffic, right? So it's always going to be the official line is everything is fine. They don't want people to panic. They know that this is all a huge confidence game. It's a con game, confidence game, con game, same thing. And it's all about maintaining confidence in this phony system. So yeah, I mean, could they be throttling the channel? I don't know. Could be. There's no way to know these things, right? If you think that the channel's being throttled and this information is being suppressed, hit the like button. That's all I can tell you. That's your way to fight back. Get the algorithm to pick up on this video. Force the algorithm to share this information. Force them. Smash the like button. Okay, so back to being slightly serious here. We've got the savings rate is being diminished. Consumer spending is falling. We've got that revision that shows that. Now, one of the things that was brought up at the FOMC presser a couple weeks ago was the huge balance of credit card debt that consumers have taken on. Now, this is another one of these big differences between now and 2008. Again, the national debt was much lower then. Well, so was consumer debt. Look at the credit card balances in 2008, about 330,000. Now, up to north of $1 trillion. So, consumers are enormously tapped out. They are putting basics like food and gas on credit because inflation is tapping them out. Real wages are declining because the purchasing power of the dollar is getting eviscerated here. And that's not going to stop. And yet consumers, despite the fact that interest rates on credit cards are some of the highest on record, they're piling on credit card debt. Not only that, but we have a record number of consumers who are rolling over the balance and paying that interest. Now, when this was brought up to Jerome Powell, he pointed out that Well, yeah, there is an increase in delinquencies on credit card balances. He didn't even acknowledge the fact that it was a problem that balances were over $1 trillion now. He just kind of, we'll just ignore that. But he did mention that despite the fact, this is the delinquency chart, by the way, from the Fed, a delinquency rate on credit card loans, all commercial banks. So he pointed out that despite the fact that the delinquency rate is increasing sharply, and it is, that's a pretty sharp move up. Another time when that happened in 2008 was or I'm sorry, another time that we saw a sharp increase in the delinquency rate was back in 2008. And if you look at this chart, you think, well, it was coming off of a record low. That's what Powell pointed out. And now, sure, it's going higher, but it's still historically low, right? And that's true. Although I think it is alarming that the rates are moving up so quickly. I mean, what's this chart going to look like in a year? I think it's going to look more like this, if you ask me. But look, that's not the only data point to pay attention to. Now, look at this chart. This looks a lot different, folks. This is the delinquency rate on credit card loans, but for banks that are not among the 100 largest in size by assets. So this is the delinquency rate on credit card debt that is being issued by small banks. Well, this looks a little bit different, doesn't it? It is at the highest level on record. So, if we want to talk about the disproportionate effect of interest rates on small businesses and also on small banks, this is indicative of it. This could be a real problem for the smaller regional banks. I mean, they are getting a triple whammy here. They're going to see increased delinquencies on this credit card debt. They are seeing a devaluation in their bond portfolios. They have all of this low yielding US Treasury debt that they bought up during the crisis when rates were super low. Now that rates are spiking back up, it's like, well, sorry, banks, sorry you have all this worthless, low yielding debt. But don't worry, the Fed will come in and have programs like the Bank Term Funding Program where they'll just take those bonds. They'll say, well, the face value is X, even though the real market value is significantly lower, but we'll take them at X as a collateral and we'll loan you the money. So basically, those bonds are going onto the Fed balance sheet. And at the time, right now, I think it's about $108 billion on the Bank Term Funding Program, how much they've loaned out. The existing balances is the highest it's been since it was begun in March, but that program is going to get much, much bigger. And at the same time, you've got mortgage rates spiking up. So these regional banks, and all the banks really, but it's a big problem for the regional banks, the mortgages that they wrote for these home buyers when rates were at 2 or 3%, now that the average 30-year mortgage is over 7%, it's the same problem that they're having with the bonds. They're devaluing because these debt instruments, they have this low yield. And yeah, sure, if you hold on to that mortgage for 30 years and you collect your 2%, you'll get your money. But, what's the purchasing power of that dollar going to look like after 30 years? So, it's a huge problem for these regional banks. And all of these problems are significantly worse than in 2008. And that is why, when you're preparing for a crisis of this magnitude, it's not going to be a real estate crisis. It's not going to be a banking crisis. It is a everything crisis. The US federal government is insolvent. I mean, we just narrowly avoided the government shutdown by 45 days? They're going to have another shutdown in 45 days if they can't agree to, borrow a huge sum of money from the future and spend it into the now, which, by the way, is enormously inflationary. So, you get the Fed spinning its wheels, hiking up rates, trying to fight inflation. Meanwhile, the federal government, they're out of money and they are running record deficits just to keep the wheels going on this machine. It's not a good scenario, folks. It is a recipe for disaster. It's a recipe for a sovereign debt crisis, and that is what we are headed towards. And look, when the cracks start to show, I don't know what it's going to take for the Fed to return to debt monetization and money printing, but I'm pretty confident that that's where we're headed. We might see a big sell-off in gold and silver and in assets across the board. So, have some dry powder. I got Peter in the chat here saying, save your money and be ready to buy. I would agree, but I also would be cautious about waiting too long because I do think that when the crisis really breaks out, we're going to see a repeat of March where the physical metal, even if the spot price is declining, the premiums and availability on this stuff are going to decline significantly. But for now, we have the benefit as stackers that everybody thinks a soft landing is around the corner. You got everybody preaching that everything's going to be just fine. And that is a lie that is being perpetrated that we can play to our advantage. Because, if investors out there, if individuals are behaving as if everything is going to be fine and it means that we can get gold and silver at a discount, well, I think that that is a scenario that I would like to take advantage of. Not financial advice, not telling you what to do. We got Joshua Talbot saying, I steer clear of platinum. Gold and silver is what most people know. Yeah, I tend to agree with you. I do have an ounce of platinum here. Platinum is kind of a speculative thing. I mean, one thing is that there's not very much of this stuff, so you do have the potential for rapid price movements. I mean, we saw that following the invasion of Ukraine. We saw it in the palladium market, which is a platinum group metal. I do think that there's some potential for an increase, a significant increase in the price of platinum, but yeah, primarily I stick to gold and silver, especially silver. I mean, I view silver as the most undervalued asset in the world right now. I mean, at $21 an ounce, considering what we are facing, this is absolutely incredible. But I'm going to continue stacking, folks. Again, I don't suggest anybody do the same, and really, it depends on your individual situation. But one thing that I do think would be wise would be to understand that there's not a soft landing in store for us, and that it's a strong possibility there may be a financial crisis around the corner which is worse than the Great Depression. It's certainly going to be worse than 2008. I mean, the numbers make that very clear. Let me know what you think in the comments down below. Are we headed for a crisis worse than 2008? In fact, before I wrap this up, put it in the chat. If you think that we're going to have a soft landing, put a 1. If you think that the crisis will be worse than 2008, put a 2. I would really like to know what everybody here thinks, although I think I know, because the folks watching this channel, you're probably a little more tuned in to reality and economic reality than your average individual. Someone put 3. I don't know what that means. Anyway, thanks for tuning in today, everybody. Get prepared, stay safe, and happy stacking, and I will catch you next time. Smart Silver Stacker, out.